Financial accounting is concerned with reporting financial information to external parties, such as stockholders, creditors, and regulators. Managerial accounting is concerned with providing information to managers within an organization so that they can formulate plans, control operations, and make decisions. Purposes of cost classifications are 1. Assigning costs to cost objects. 2. Accounting for costs in manufacturing companies. 3. Preparing financial statements. 4. Predicting cost behavior in response to changes in activity. 5. Making decisions. Learning Objective 1 is to understand cost classifications used for assigning costs to cost objects, direct costs, and indirect costs. Direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. Examples are direct material and direct labor. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other cost object. An example is manufacturing overhead. Common costs are indirect costs incurred to support a number of cost objects. These costs cannot be traced to any individual cost object. Learning Objective 2 is to identify and give examples of each of the three basic manufacturing cost categories. Manufacturing costs are classified into three main categories: direct materials, direct labor, and manufacturing overhead. Direct materials are raw materials that become an integral part of the product and that can be conveniently traced directly to it. An example is a radio installed in an automobile. Direct labor costs are those labor costs that can be easily traced to individual units of product. An example is wages paid to automobile assembly workers. Manufacturing overhead includes all manufacturing costs except direct material and direct labor. These costs cannot be readily traced to finished products. It includes indirect materials and indirect labor costs that cannot be easily or conveniently traced to specific units of product. Examples of manufacturing overhead: depreciation of manufacturing equipment, utility costs, property taxes, insurance premiums incurred to operate a manufacturing facility. Only indirect costs associated with operating the factory are included in manufacturing overhead. Manufacturing costs are often classified as prime cost and conversion cost. Prime cost is the sum of direct material and direct labor. Conversion cost is the sum of direct labor and manufacturing overhead. Non-manufacturing costs are selling costs, which are costs necessary to secure the order and deliver the product. They can be either direct or indirect costs. Administrative costs are all executive, organizational, and clerical costs. They can be either direct or indirect costs. Learning Objective 3 is to understand cost classifications used to prepare financial statements, product costs, and period costs. Product costs include all the costs that are involved in acquiring or making a product. Product costs attach to a unit of product as it is purchased or manufactured, and they stay attached to each unit of product as long as it remains in inventory awaiting sale. For manufacturing companies, product costs include raw materials, which are any materials that go into the final product. Work in process consists of units of product that are only partially complete and will require further work before they are ready for sale to the customer. Finished goods consists of completed units of product that have not yet been sold to customers. When direct materials are used in production, their costs are transferred from raw materials to work in process. Direct labor and manufacturing overhead costs are added to work in process to convert direct materials into finished goods. Once units of product are completed, their costs are transferred from work in process to finished goods. When a manufacturer sells its finished goods to customers, the costs are transferred from finished goods to cost of goods sold. Product costs include direct materials, direct labor, and manufacturing overhead. They are recorded as inventory on the balance sheet and recognized as cost of goods sold on the income statement when the products are sold. Period costs include all selling costs and administrative costs. They are expensed on the income statement in the period incurred. Which of the following costs would be considered period rather than product costs in a manufacturing company? A. Manufacturing equipment depreciation. B. Property taxes on corporate headquarters. C. Direct materials costs. D. Electrical costs to light the production facility. E. Sales commissions. Property taxes on corporate headquarters and sales commissions are period costs. Learning Objective 4 is to understand cost classifications used to predict cost behavior: variable costs, fixed costs, and mixed costs. Cost behavior refers to how a cost will react to changes in the level of activity. The most common classifications are variable, fixed, and mixed costs. A variable cost is a cost that varies in total in direct proportion to changes in the level of activity. A variable cost per unit is constant. An activity base, or also called a cost driver, is a measure of what causes the incurrence of a variable cost. Examples include units produced, machine hours, miles driven, and labor hours. A fixed cost is a cost that remains constant in total regardless of changes in the level of the activity. If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity. Committed fixed costs are long-term and cannot be significantly reduced in the short term. Discretionary fixed costs may be altered in the short term by current managerial decisions. A straight line closely approximates a curvilinear variable cost line within the relevant range. The relevant range of activity pertains to both fixed costs as well as variable costs. For example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. Fixed costs would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. The relevant range of activity for a fixed cost is the range of activity over which the graph of the cost is flat. Within the relevant range of activity, total variable costs increase and decrease in proportion to changes in the activity level. Variable cost per unit remains constant. Total fixed cost is not affected by changes in the activity level within the relevant range. Fixed cost per unit decreases as the activity level rises and increases as the activity level falls. Which of the following costs would be variable with respect to the number of cones sold at a Baskin and Robbins shop? A. The cost of lighting the store. B. The wages of the store manager. C. The cost of ice cream. D. The cost of napkins for customers. The cost of ice cream and the cost of napkins for customers would be variable costs. A mixed cost contains both variable and fixed cost elements. Consider the example of utility cost. The fixed element of the utility bill is constant regardless of kilowatt hours consumed. This cost represents the constant monthly utility charge. The variable element of the utility bill varies in direct proportion to the consumption of kilowatt hours. The total mixed cost line can be expressed as an equation: y equals a plus bx. In the equation, y is the total mixed cost, a is the total fixed cost, or the vertical intercept of the line, b is the variable cost per unit of activity, or the slope of the line, and x is the level of activity. If your fixed monthly utility charge is $40, your variable cost is 3 cents per kilowatt hour, and your monthly activity level is 2,000 kilowatt hours, what is the amount of your utility bill? $40 plus 3 cents times 2,000 equals $100. Learning Objective 5 is to understand cost classifications used in making decisions: differential costs, sunk costs, and opportunity costs. Decisions involves a choice between alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. To make decisions, it is essential to have a grasp on 3 concepts: differential costs, sunk costs, and opportunity costs. Differential costs, or incremental costs, are the difference in cost between any 2 alternatives. A difference in revenue between alternatives is called differential revenue. Both are always relevant to decisions. Differential costs can be either fixed or variable. Sunk costs have already been incurred and cannot be changed now or in the future. These costs should be ignored when making decisions. Opportunity cost is the potential benefit that is given up when one alternative is selected over another. These costs are not usually found in accounting records but must be explicitly considered in all decisions. What is the opportunity cost you incur by attending class? When you are trying to decide whether to drive or take the train to attend a concert, is the cost of the train ticket relevant to the decision? Because the cost of the train ticket is a differential cost, it is relevant to the decision. When you are trying to decide whether to drive or take the train to attend a concert, is the annual cost of licensing your car relevant to the decision? Because the licensing cost is the same whether you drive or take the train, it is not a differential cost and therefore not relevant to the decision. Suppose that your car could be sold now for $5,000. Is this a sunk cost? The original amount you're paid for the car is a sunk cost. The amount that it can be sold for now is not a sunk cost. Learning objective number 6 is to prepare income statements for a merchandising company using the traditional and contribution formats. The traditional format organizes costs by function. Costs relating to production are grouped together, as are selling and administrative expenses, without regard to cost behavior. The traditional format is used primarily for external reporting. The contribution format organizes costs based on cost behavior and is used primarily by management. The contribution income statement format is used as an internal planning and decision-making tool. We will use this approach for 1. Cost volume profit analysis, Chapter 6, 2. Segmented reporting of profit data, Chapter 7, 3. Budgeting, Chapter 8, 4. Special decisions such as pricing and make or buy analysis, Chapter 11. End of Chapter 1.